So, I mean, you know, wow. And that's one of the worst day ever. Yeah, they trip all that bad. Spread your hair out. You can still see it. Okay. One of the last things we need to look at here was this production mix and yield variances. And basically what we're going to do is we're going to take that efficiency variance and break it down. And what we're going to break it down is we're going to have that production mix variance. And basically, all we do there is, again, this is when we have a variance due to the change in the relative proportion of inputs. You know, it could be a material mix or a labor mix variance. Again, you can do this for, I think one of your homework problems is labor. But you, same philosophy here. But coming in, okay. It's simply the mix variance is simply the standard input price times the actual quantity minus the actual input used at standard mix. And we'll work a prop here in a minute with it. And again, basically what this is, what we're measuring here is the substitution, the impact of substitution on material for another. And the yield variance measures the difference between the expected output from a level of inputs and the actual output obtained. The expected level output difference from the actual output. And again, yield variance again, standard input price times actual input and standard mix minus the standard input allowed. And again, it's just measuring the input-output relationship. Are we getting the amount of the output that we said we would if the standard mix is constant? And yeah. Now, let me say, what are we doing? Look at problem 35. Let's use those numbers. Okay. Give my blood for this class. I know. Blood, sweat, and tears. Good group. But none of y'all probably even know who they are. Way before your day. Huh?
I never heard about blood, sweat, and tears.
Oh, they were a good group.
What's the biggest?
Can't think of it. They said top. Yes. Late 60s. They're a band out in New York City. you want to. A lot of horn and brass. Okay, here we got the Houston Corporation. They manufacture a wide variety of chemical compounds and liquids for industrial use. The standard mix for producing a single batch of 1,000 liters of rust-off is as follows. And we got the alpha, beta, and gamma. And we got the quantity in liters, the cost per liter, and total cost for that. There is a 20% loss in liquid volume during the processing due to evaporation. The finished liquid is put into 5-liter bottles for sale. Thus, the standard material cost for a 5-liter bottle is $78. The actual quantities of direct materials and cost of materials placed in production during March were as follows. And the materials purchased and used are the same amounts. And a total of 16,000 bottles of 80,000 liters were produced during March. Now it says calculate the total material variance for the liquid product for the month of March, and then further analyze it, the total variance into price and efficiency, and then break that efficiency down into mix and yield. Okay? Now, first of all, what would we say is the total material variance? Any ideas?
Would be 6,960 barrels.
Sounds about right. How'd you get there?
I just took the total cost of making 1,000 liters, which is 15,600, and then multiply that by 80 to get your your standard total cost, your budgeted total cost.
Okay, remember the prongs? We can do that, can't we? This is on actual times actual. What's actual times actual?
1,241,040.
Yeah, that's given to us, right? And standard, standard times standard, you said was 1,248,000? Is that what you said?
Yeah, that's right.
And it said you got that by taking what? 80,000 times the 15.6?
Well, 80 times 15.6.
Well, yeah, you're right. It'd be 80. You gotta remember it's 81,000 liters. Okay? What about the middle prong? You know, actual quantity times standard price. How are we going to come up with that? Or can we?
Wouldn't it be the 16,000 times the 78?
Nah. What did you come up with when you do that? $9,248,000 standard times standard.
Is it 1,311, 140?
Getting closer.
1,305, 120.
Huh?
1,305, 120.
I'll buy that one. How'd you get that, sir?
The actual quantity in liter times the price per liter.
Okay. Actual quantity in liters times the price per liter, the 9, 12, and 24, and add them up. Again, so what you would do, you would take the 50,400 times what, 9? And then you got 37,040 times 12, and then 16,960 times 24. If you add all that up, 1,305, 120. Okay? So we can say that the materials price variance is what here, 64,080? Is that correct, Matt? Favorable or unfavorable? Favorable. And that's your price variance. And over here, 52, 57, 120. That's our efficiency variance or usage. Is this favorable or unfavorable? Unfavorable. Now that's what we've done so far in the prior chapter, right? Everybody with me and okay there? Now we're going to take this 57,120 and we're going to break it down into mix and yield variances, okay? Now, basically what we need to do is do each material separately, okay? And if we want to do it, we can do it several ways, but one way to do it and this is alpha. Let's do alpha here. Okay. First of all, this problem over here, let's do actual times actual. Okay. What do we actually spend on alpha? 423, 360. Those are nice ones they're given to us, right? Now, if we do the standard price times the actual quantity, standard price times actual quantity.
453,600.
453,600. And everybody okay with how we got that? We simply took $9 times, what was it, 50,400? Now we can say the difference in these two numbers right here is what? What's the difference between these two?
Price variance.
What?
Is it price variance?
Yeah, but how much? It's up to 240.
30,040.
Okay, favorable or unfavorable? Okay, we got a favorable price, and you're right, that is a price variance for alpha. Everybody A-okay so far, right? Now, one of the first things I guess we need to find out is what's our standard mix. We'll need that for all three of these. So what percentage is our standard mix? Before we go any further, let's just come back and get that. Alpha, we got beta and gamma.
Is it 48% for alpha?
How'd you get that?
600 over 1250.
That's exactly right. The 600 over 1250. Again, notice all we're doing is using the numbers at the bottom of page 650 there. Yeah. 650. Now, and then beta would be what, 450 over 1250? What is that? 36%. And by process of elimination, 200 over 1250, it's got to be what, 16%? Because it's got to add up to 100%, right? Again, 200, 1250, and another one was what, 450 over 1250. Okay, everybody kosher with that, right? Now, let's go back up here and let's find out our standard price times our standard quantity, what it should have been. Again, standard price times AS cubed. And you say, what the heck is that? Well, our standard price is what, $9? Okay. What was our, what should have been the standard amount?
600 liters should have been, or 600.
48,000.
Huh?
48,000.
How many liters did we actually total use? 104,400, right? What percentage should have been alpha? 50,112. Now, if you're asking, where does that 50,112 come from? Again, it's 0.48 times 104,400. There's where you get to 50,112.
So will your last prong there, will that be 48,000, which is 80,000 liters at, like, what should have been, how many you should have
Hang
out
on,
from there?
we'll get there. Okay, what's this, by the way, what's that multiply out to? 451,008. Okay. Now, over here, and this is our flexible production budget, this prong, we're going to take $9 times our standard quantity. What was our budgeted quantity? 600 liters or whatever times 80. We made 80,000 liters, right? For every 1,000 liters, we should have used 600 of alpha. And so what the heck are we coming up with there? 432. Okay. Now we can go in and plug. The difference in these two numbers, 453, 600, something 592, but 2,592? Favorable or unfavorable? Yeah. Number to the left is favorable, is higher, so it's unfavorable. And then here the difference is 451.08 and 432. Favorable or unfavorable? Unfavorable. You say, what the heck is this? This is your yield. right here is your mix variance. And these two together would be what? 600. 21.6, is that right? Unfavorable. That's your efficiency variance right there for alpha. Does that make sense? Everybody okay? What we did. Okay.
So question.
Yes, ma'am.
Okay. So as just in general, the total efficiency variance is 57,120 for the entire company.
Mm-hmm.
For just that specific product,
Mm-hmm.
is what we just found.
Right.
Okay.
We got to do the same thing for beta and gamma, and when you do, you can add those three up, and
And then we'll get back, okay.
you'll get back to that 57,120.
So when we add the efficiency variances, or so all three price variances add up to the company that
64,080.
That was our question. Right.
Okay? That makes sense? Going through the same rigmarole again, only this time with beta. Okay, actual times actual is given to us as what? 400 and 464. Okay. What is our standard price times actual quantity?
144,480.
A lot of fours. Again, would be what? $12 times 37,040. Everybody okay with where we're getting at? Standard price of $12. Again, this is just actual times actual, and that's given. So our price variance for beta would be what? 44,016? Favorable or unfavorable? Favorable. We did something right behind it, right? Now, then we got to come up here and we're going to take, again, standard price, which we know is 12, times 36%. And again, where are you getting 36%? Back here. 36% on beta. Times 104,400. What do we get?
451,008.
You multiply that. What's the units up there? Should be.
Oh, sorry, 37584.
584?
Yeah. So is it just a weird coincidence that that number's the same as it was for alpha?
Yeah, that's just a freak occurrence. The difference in price per unit was proportionate. That's how it worked out. That, yeah, don't take that, it'll be that way, because you'll find out when we do gamma, it's not the same. Okay? And then over here, we're going to have 12,000 times, we got 450. Yeah, I had to back over there. 450 times 80. And what the heck does that come out to? And it's going to come out proportionally the same number because the 12 and the 9. 432, isn't it? That's a freak coincidence, by the way. I didn't even notice that when looking that over. Okay, so what is our mix variance here?
That is 6528. Favorable.
Favorable. What's yield?
19008.
19,008.
Unfavorable.
Unfavorable. Okay. Now, again, combining these two, what do we get?
$12,480 unfavorable.
Again, that's your efficiency variance. Okay, yes. Excuse me. And everybody okay while we're using 80 up there? 450 times 80? Because you made 80,000 liters and we're talking 1,000 allotments there. Over on that agreement, it says for each batch, single batch of 1,000 liters. So we made 80,000 batches. Or I mean 80,000. 80 batches of 1,000 liters. I'll say it right one of these days. Okay. Now, same old thing for good old Gamma. Sounds like a sorority. Good old Gamma. And so actual times actual is given to us as what, 417, 216. Okay. What standard price was $24? 24 times 16,960.
407,040.
407,040. And that's going to give me a price variance of what?
2,176.
10,176? Unfavorable. Now let's just check ourselves for a second here. Make sure that Lauren is correct. On a price variance, we had what? Alpha. Here that's a beta, gamma. And we said on gamma it was 10,176 unfavorable. Beta was what? 44,016 favorable. And alpha, if I can spell, I'll be dangerous, was 30,240 favorable. If we add those up, what does that add up to? Let's check and make sure.
64,080.
Is that what we said originally?
Sure.
So that's total price variance. So it does check out. Okay? Just want to make, always good to make sure, you never know. Never know. Okay, back to over here, we got what, 24 times, poltergeist. I don't know why we need to win this open anyway. It's cold as can be in here.
The power went out here for a reason.
Hey, we don't want to do anything that'll screw up the electricity around here, guys. The Morehead State's utilities are fragile right now. You know,
They're like, we're in a budget crisis.
huh?
And they're like, we're in a budget crisis. We can't fix it.
Hey, tell me about it. And they'll raise in 5 years.
They're raising 22.
Huh?
Well, I had to raise it 22.
Yeah, but you're getting ready to get a good one. Yeah. Okay, going back here, we said gamma was 16%. Again, 16%. 16% times that 104,400. And what the heck do we get when we do all that?
4,896.
408.96. Now again, notice here's a different answer, Lauren, for you. Okay. And then over here, on this one, we got $24. times the 200 times 80. And what number do we get there? 384. And so our difference here for the yield variance will be favorable, unfavorable. And over here we got what?
6144.
6144? Thank you. So our efficiency variance overall, 040. Now again, we can go back and add all those up, and they should, and they would. We should come up with an overall efficiency variance of 57,120. Now we can add them up and come up, and if you add up total mix and total yield variance, you should come up with 2208 unfavorable and 54,912 unfavorable. Again, add those together gives you that 57,120 unfavorable. Okay? Three variants. But that is how we break down the efficiency variance. We'll see what's the difference in the mix, change in mix, and change output to input. Okay? Everybody kosher with that?
Can our exam problems be exactly like that?
What?
I'm just saying, it seems so easy when we do it here. And then I get that exam. It's all story.
That's going back and looking at formulas and plugging numbers into formulas, all you're doing, basically. I mean, on a variance, that's what it's going to be like. Okay. And you've got this example. Well, I wrote up. I mean, you've got this example that takes the numbers and does the same thing for you that we just did. And you can go on Blackboard and look at that and follow it as well as I can going over it. By the way, notice the journal entries. I did slough off that real quick. Notice accounts payable is going to be the actual work in process inventory is going to be your standard input that you're debiting, and your variances you just record it for each individual ingredient. And again, if it's a debit, is that favorable or unfavorable variance?
Unfavorable.
Exactly. If it's a credit, it means it's a favorable variance. Just plugging it in on a standard costing system. All you've done is taken efficiency variance and broken it into mix and yield on each ingredient. And labor, you would have skilled and unskilled, might be one way to get two different classes. Under different types of laborers. And it's the same mathematics. Nothing's changed. From materials to labor. Okay? Now, and somebody asked us actually, 282 class just appeared for this, because we're looking at variances there. Of course, we're not getting into yield mix and all that, sales variances and all. We're just doing materials, labor, and overhead, and basically materials and labor. With principal students, you're up on a higher plane up here. But they asked, is this only just for manufacturing variance analysis? And I told them, no, actually, it can be used in your service and retail. Obviously, material maintenance is not going to be big in service because you don't have them. But, labor variances, obviously, in a service firm, what's going to be your key cost? is going to be your labor, right? So keeping track of it and finding out why we vary with different events. And again, variances don't give us answers, but it does allow us to sort of narrow down what type of things we should be looking for. Okay? And so, yes, they are used. You know, as it says there, you know, we can use it in service and merchandising, and some of the things of the units that they're putting it into is, you know, output could be, you know, for a retail could be amount of sales units. Service organizations, you know, professional staff hours for an accounting firm. Guarantee you, at some point, some of these firms are going to be looking back at tax season and all that, looking at the input of their professional staff and supplemental staff and output and in terms of returns and all that. You know, hotels, guest room, you know, guests, number of nights, occupancy rates. Trying to read that. Airlines, revenue miles, seat miles, patient days, again, occupancy rates in the hospital. I know King Starters looks at occupancy rates because I know several people down there, and I'm always asking, well, how's business? You know, sort of a unique industry in that, you know, hey, business is good means everybody else is doing bad. But, you know, misfortune helps them. But it's like us here at Moorhead. I mean, what do we look at? What do you think some of the measurements that Moorhead would use for evaluating and budgeted to standard and all that?
Tuition hours?
Credit hours. Billable credit hours would be one. You know, lo and behold, what the National Day the other day, they set up the budget next year anticipating a 4% increase in tuition, and the council said, nope, you can only do 3%. And now they're all in a tizzy. You know, like, oh, what would be on results? Now, you guys should like it because it's saving you a little bit of money on tuition next year. But that's, you know, of course, I'm always wondering who's doing your budgetary process here. One of the first things I would do would be contact the council and say, okay, what rate can we anticipate of being allowed next year? And does it make sense to set a budget up if it's not going to be realistic and you can't implement it? And, you know, here, classic example of getting a cart in front of the horse. We went through and they did the whole annual budget for our fiscal year is July 1, June 30. As with most state governments. And everything in Kentucky is, basically. But they planned a budget and forgot about the most important thing. You better find out what rate you can set it on. Because in Kentucky, the university does not set their rates. Well, they do, but they have a parameter, a limit. And so the council sets that. And so, council on higher ed. And it's a public meeting, by the way. Sometimes students do go and protest the tuition increases have in the past. But, you know, that's the thing about it is it's where we start at and how we can measure it. So, yes, we can. You know, and merchandising and service organizations obviously are going to be looking at administrative and marketing costs and trying to control them. Because again, that's where a large part of their, you know, budget goes to. And so measuring efficiency and controlling those costs are important. I mean, you know, in order, what costs do we look at and function on? You sort of need to rank them. You say, what do you mean? Well, again, if we're trying to control our costs and looking at variances from actual budget and all that, and getting the handle on these things, if we got a cost that's, you know, 2% of our budget, so what if you control it and improve it 10%? 10% of 2% is not going to make a dent that much. But if you make a 3% change on an expense that's 60% of your cost, then you're making some significant change. So again, you know, it's where do you want to spend your time and effort? It's really comes down to the old logic, where do you get the biggest bang for your buck? And that's where you're going, they talk about where do the management, where do they go to look at and do things? Well, obviously, where it's going to make the biggest difference. Common sense hopefully comes into play, unlike here. Now, I got to tell you this, I may have told you this already. We had our syllabi evaluated. There's a checklist of things that should be on our syllabi. And on common syllabi, I had 2 things marked off on mine. And it's not a big deal. It's not like they wrap your knuckles or whatever. But the 2 things I'd left off, I didn't have attendance policy stated. And y'all know I don't have attendance policy. For an online class, you do the work or else, duh. And for here, if you don't want to come to class, that's fine. I'll get you on exams and stuff. That's where I get my attendance. And 2, I do take it to learn names, and also to benefit of doubt on some things. If you've been here, you get benefit of doubt. And so that's okay. What we're about. Then the other thing was the syllabus needs to be available in electronic format. And I emailed the law boss back and said, wait a minute, I always post it on Blackboard. It's available on electronic format. And I thought that's what they're telling me. And he said, well, I'm passing this over to Sam because he's the one that evaluated it. So I get this email that night. And after I read the email, I just cracked up. Because what it was is not that I failed to have it in electronic format. What I failed to do was put a sentence on it saying it was available in electronic format. But I sort of figured you people could figure that out because you're getting it off a Blackboard, and when you click onto it, since you're looking at it on a computer, I sort of figured y'all knew it was electronic format right then and there. But no, I'm supposed to put that sentence on there. It is available in electronic format. And I'm really seriously thinking about doing next semester is this syllabi is available in electronic format. Obviously, you know that since you're looking at it on the computer. But administrators really can't decipher this, so this is why this sentence is in here. But I mean, I cracked up like, you've got to be kidding me. I've got to put a sentence on there that, I mean, it's like getting instructions on how to fix your computer, but it's on the computer, and step number 1 is turn the computer on. Well, in order to read these, the computer has to be on, It's like, some things are a little bit self-evident. Of course, I guess it's like Google and all that, MapQuest and all that, when you get directions from your doorstep, they say, go out the front door. I can probably get out of town okay. We can start from there, you don't have to start at my exact doorstep. I know how to get to the interstate. But I mean, it's hilarious how we're dumbing down everything. Like, there's got to be some assumption of knowledge. Anyway, I got tickled at that when I finally figured out what they were wanting. Okay. Well, again, a little bit, which variance, before we get that, obviously for a service firm, key thing they're going to look at is labor cost. Accounting firm, what are they going to key on? Well, labor, professional and staff. I mean, you look at your total budget, your total cost structure of a CPA firm, I bet labor is going to be pretty much 90-some% of your total cost. So that obviously would be what you would be looking at. For hospitals and all that, occupancy costs, prime would be a key one. Again, efficiency variances would be very big here. Looking at mix and yield that, and like notes in that, jobs that are routine, common function, but they do lead to good use of efficiency variances. Non-routine jobs, generally not. Obviously, there's nothing to measure by or compare to. And the thing about it is, looking at when we look at mixed variances, how well can we substitute? Staff labor for professional labor in a CPA firm. How interchangeable are the components? And so again, it's looking at that mixed variance will tell a lot there. Now, which variances do we investigate? Again, cost benefit analysis. Where do we get the biggest buck? bang for our buck, just like I said. And the thing about it is, a lot of firms do a management by exception. Again, they generally have a statistical model, exact what percentage of the deviation do they have to have a variance before they deal with it. But again, and like it says, a budget, a standard, industry average, prior period experience, a gut feeling rule of thumb sometimes. You know, when is the actual differ from this, and by what percentage must it differ for that we need to look at. You know, just a personal example, I got a cousin that owns a restaurant, and he always is measuring his food input cost. You know, what percentage of sales is his materials, and what's in, and he compares himself to others in the area and industry averages. You know, how much of my sales dollars should be going to my food, and how much to salaries, you know, wages, staff. And again, he's doing management by exception. When it's out of line, he does look at it and see, okay, what corrective action can we take? What's the problem? Now again, with all these things, what I've told you before, make sure your standard, your budget, whatever tool you're using to measure by, make sure you got 36 inches in a yard. In other words, make sure your standard is realistic. And like with this food cost, and right now we've had last year or two, we've had huge increases in food costs. You notice the prices at restaurants have been inching up and portions have been shrinking. That's not only the grocery store and restaurants, both, right? Go look at buy ice cream now, you don't get a half gallon for that price. It's smaller. Again, the costs are creeping up. I once saw a thing that was interesting. It was the size of a Hershey candy bar. And what somebody had done, they did a photo shoot of it over the years. And basically, Old Man Hershey, and there was an Old Man Hershey, started a company. He wanted his candy bar to sell for a nickel. And it didn't change from a nickel, I think, until mid-60s. It was in my lifetime it changed. But they did a pictorial, and you could actually tell it would go like this. You know, when costs went down, candy bar got bigger. Costs got up, materials, labor, whatever, the size of the candy bar shrank. And then finally, by the 60s, it got to the point that it was going to be so small nobody would buy it, so they had to up the price to 10 cents. But it was actually an interesting way to measure the flow of costs in it. They adjusted the size of the candy bar to fit the amount of the cost. Huh? No, that was a different product. I think it's actually interesting if you go look at candy bars, how they got their names. Fifth Avenue is named after Fifth Avenue in New York. Payday, it does refer to payday, but you know when it was first created? During the Depression. Payday had a good connotation. You had a job. That's why they called it that. I was trying to think some of the others you know, Hershey was Old Man Hershey. You know. But I was trying to think some of the other ones I've read across in the names. Baby Ruth. Now, the misnomer is what do most people think Babe Ruth candy bar is named after? Baseball player. It's not. The candy bar was before Babe Ruth. It's named, I think it's Cleveland. Grover Cleveland. His daughter was Ruth. Baby Ruth. That Grover Cleveland, president of Cleveland, it's named after his daughter. Trivia to the deal, right? Again, the thing about it is, when we're measuring which variances to investigate and all that, couple of things, like I said, get the biggest bang for your buck, the impact, you know, which variances are going to give us the biggest impact that we can make a change. And also, too, controllability. looking at which ones do we have the ability to manipulate and make changes in. You know, volume variance, ain't much you can do there. Variable overhead efficiency variance, not much you can do with it. It depends on how you're applying the variable overhead. So it's really not much use to go in and deal with it. So again, you're looking at, you know, is there something we can do about it? And if there isn't, doesn't make much sense to spend time trying to spin wheels and come up with how do we improve this from unfavorable to favorable. Can't control it. And again, you know, low impact, uncontrollable variances, not going to get much attention. You're probably know that. Again, the longer the time interval you're talking about, how much time do we have to make corrective action to make changes, that's going to broaden out the ability to control the different variances. If you're talking about short run, you may be limiting yourself as to what can actually be done. You know, and so, you know, some problems are going to be corrected as soon as they're identified. You know, when the cost is low. I mean, like a labor efficiency variance, if we're looking at workers are cutting off work early, they're taking longer lunch breaks and things like that. Obviously, things like that can be corrected very quickly and very low cost. Or materials where, you know, some companies have found that, hey, our purchasing department's getting kickbacks and things like that. And they're buying, they're paying a higher price than what the open market. We don't have a good bidding process. And so you do have some things to look at that way. You know, that's the type of thing that you're looking at here. And a couple of things there. Where can you have the biggest effect there, the impact, and again, ability to control it. I have no idea. I have no idea what the dog and the veterinarian up there, and I don't know what to suggest what the veterinarian's doing.
Because he's trained his dog, therefore he's able to control.
Okay.
I think it's just a number.
And that is the end of this chapter.